Alright, so in this video I am going to give a really basic description of what a down payment is toward purchasing a new home. A lot of questions I get when I'm out showing clients or meeting them for the very first time is, well, what's a difference between a down payment and closing costs? They don't understand there's two different things. So in this video it's going to talk about a down payment, and we're going to get into what closing costs are a little bit as well further down. So let's get started. Okay, so I'm assuming you came to watch this video to find out what a down payment is. So unless you can buy your home for cash, you're going to need financing to buy a home from a bank or a mortgage lender. This financing is known as a mortgage. That is what you're going to need unless you're paying cash to buy a home. Now, there are times when a bank will lend you the entire amount that you need to buy a home, but that's pretty rare. This is known, though, as a 100% financing. However, most mortgage loans require some contribution from you, the borrower. They want collateral from you to make sure that you're a very strong buyer. So this contribution, the amount that you put toward the house, is called the down payment. So let me give you a real easy example so you can see what a down payment is. So let's say, for example, you're going to purchase a home for $100,000. and you're going to borrow $90,000 or 90%. You would put down $10,000 on the purchase of that house. That's a 10% down payment. So that was a very easy, basic example of what a down payment is on a home. So on that example again, $100,000 mortgage, that person put 10% down or $10,000. and they're financing 90% of the purchase price, or $90,000. But now you may be wondering, all right, well, that's great. That's a simple example. But what's the average down payment on a home for a first-time home buyer? Well, many first-time home buyers believe that you need 20% down. But when they start exploring mortgage options, they find that they can afford a house with far less money than they expected out of pocket. So, in fact, the average down payment for a first-time home buyer is just 6%. So on a $225,000 home, that happens to be the average in my market, that comes out to $13,500 on a down payment. So again, $225,000, 6% down, that's the average. That comes out to $13,500. So just take that purchase price of the home, whatever it is, times 6%, and that is the average. There's lots of other programs which we're going to get to right now that you don't have to do the 6% down. So now you're allowed to even put down less. If you have a credit score of 620 or better, you might qualify for a mortgage with just 3% down, or $6,750 on that same example of $225,000 house. Thanks to the low down payment mortgages available today, many first-time home buyers find that it's a lot more affordable than they initially thought to come up with that down payment to purchase their first home. Now, further on in this video, I'm going to get to other programs and different percentages that you can do less for, or different amounts for on the down payment. But let me go back now to the closing costs. So, like I described at the beginning of this video, a lot of people don't understand the difference between a down payment and closing costs. So you don't want to forget about the closing costs. So a down payment isn't the only out-of-pocket expense for a first-time home buyers. You're also going to need to pay for closing costs. Closing costs cover all the fees that are associated with setting up your loan, from the lender's fees, appraiser's fees, credit report. The title company has to make a little bit of money, so there's title fees. And depending on your inspections, and sometimes your real estate agent has an office fee also. So those are all closing costs. You can do a wide range of inspections. So those inspections, office fees, title fees, those are all included in what we call closing costs. That is separate from the down payment. So closing costs are typically around 2%, maybe 3% of the loan amount. So let me give you an example. So for a $225,000 house, again, that's the average price in my market, your closing cost would be approximately $4,365. So this means you should budget for at least 2 to 3% of the loan amount in cash on top of your down payment budget. For example, if you're buying a home for $225,000 and you're planning to make a 5% down payment, you should include around 3 to 4% for the closing costs in your estimate. It's better to have a little more than not enough. So now the home price is $225,000. You're putting 5% down, or $11,250. Your loan amount, or your mortgage, is $213,750. That's the difference between the $225,000 and your down payment of $11,250. So we're at $213,750 for the mortgage. Now you got to count in 3% for the closing cost. 3% of that $213,000 is $6,412. So total savings that you're going to need for a 5% down loan and closing costs is $17,662. So as you can see, you don't only need to worry and save up for the down payment, you also need to save about 4% towards the closing costs. So you can see it's very important to budget for closing costs when you're planning to buy a home. So another question you might have is, all right, well, can I afford a down payment right now? So first-time homebuyers often overestimate how much they'll need for a down payment. Consider the FHA loan, a popular first-time homebuyer mortgage that requires only 3.5% down. So on a $250,000 house, that's about $8,750 for down payment, almost exactly equal to the amount of the average American has in savings. So of course you might decide to pay more than the required down payment for your home loan depending on your financial goals. A bigger down payment can reduce your monthly mortgage payment and help you save on interest. But if your main goal is to become a homeowner in the near future, one of these loans, like the FHA 3.5% down payment loan, could help you achieve your dreams sooner than you thought. So another question that you may have is, how much do first-time homebuyers have to put down? So normally there is an amount that you have to put down, and we're going to talk about that right now. There are some loans out there that let you put 0% down, but only certain homebuyers will qualify for these mortgage programs. Realistically, most first-time homebuyers have to put down at least 3% of the home's purchase price for a conventional loan, or 3.5% for an FHA loan. Those are the two most common types of loans that homeowners use. So now you might be wondering what I'm talking about with these 0% down loans. So let me get into that a little bit. There's a few of those, and to qualify for one of those zero down first-time homebuyer loans, you have to have some special requirements. For a VA loan, you need to be an eligible U.S. Armed Forces veteran or a service member. So VA loans have 100% financing programs. Or for a USDA loan, you have to buy a house in a qualified rural area, which means a population of 20,000 or less, and meet local income limits. Now in my area, we have very, very few USDA loans, but I just actually closed on a VA loan that the buyer had a 0% down payment. But the two most common loans, again, are conventional and FHA. That is just about what probably 95% of the population uses, or cash, and they are a lot easier to get approved for. You'll still need to meet credit score requirements as well as employment income guidelines for each of those loans, just like any other home loan, but there are no special requirements to get a low down payment FHA or conventional loan as a first-time homebuyer. Now, how much should a first-time homebuyer put down? Well, the amount you put down as a first-time homebuyer is up to you. For instance, you might qualify for a conventional loan with just 3% down, which is very common. I've had lots of those in the past, but then you'd have to pay for mortgage insurance. So mortgage insurance is also known as PMI, private mortgage insurance. Unlike homeowners insurance, mortgage insurance would not benefit you directly. Instead, it would compensate your mortgage lender if you default on the loan. So if you can afford it, you might decide to make a 20% down payment to avoid mortgage insurance, or often referred to as PMI. This would lower your loan amount and your monthly payment. Now, obviously, there are certain benefits of making a bigger down payment. Namely, you have a smaller loan amount, which means your monthly payments are smaller. You'll also be able to avoid private mortgage insurance, or PMI, if you put down 20% or more. That should shave off another $100 or more off of your monthly bill. But making a smaller down payment has benefits too, even if they aren't as obvious. So you might be wondering, what are the benefits of a smaller down payment? When you make a smaller down payment, you keep money in your pocket, or you could put that toward your emergency fund, because when you're buying a home, there are lots of unforeseen expenses that you need to be prepared for. So you can save yourself money to make improvements and repairs on the new place, which many home buyers often do. Plus, with a smaller down payment, you can get into a house and start building equity sooner, instead of saving or having to wait up to 14 years to save up the 20% down payment required. During those 14 years, I'm just giving an example of 14 years, the price of real estate will likely continue to rise along with, which isn't set in stone. If you want to get into a house sooner, it often makes sense to make a smaller down payment with what you have saved now, or what you will have saved in the near future. Later on, you can refinance, in a few years down the road, to get rid of private mortgage insurance and reduce your monthly mortgage payment. In other words, you can get your foot in the door with home ownership with a smaller down payment on your first mortgage loan. Then after you build some equity into your home, you can transition to a more ideal loan. So I get this question all the time. What is first-time home buyer down payment assistance, and how can I get that? So here's the good news. If you're a first-time home buyer, you might not have to cover the whole down payment yourself. First-time home buyers can apply for grants or low-interest loans called down payment assistance to help with their upfront contribution. There are more than 2,500 of these nationwide for these first-time homebuyer programs. Many of these programs are run by nonprofits or local governments. Qualified buyers can receive anywhere from $2,000 to more than $39,000 toward the down payment and or closing cost assistance. It's hard to generalize who qualifies for those down payment assistance because all 2,500 programs could be slightly different. But it's common for these programs to prefer first-time home buyers, low to moderate income, and targeted development areas. So look for first-time home buyer programs in your state to see what down payment assistance may be best for you and what you may be able to qualify for. These are very often run by state and local governments and can be found by Googling down payment assistant grants, whatever state you live in. So down payment assistant grants, California. Or better yet, get a hold of a local real estate agent like myself and ask them. They're going to direct you probably to a local lender who can really talk about these programs and see if you qualify, because the loan officers and mortgage lenders are the professionals and they can answer your questions a lot better. Now here's something else that a lot of first-time home buyers don't know, and this can really help you get into a home quicker if you don't quite have that down payment and closing costs saved up. You may also be able to use gift funds to cover your down payment. Many first-time home buyer programs let you cover the whole down payment with a gift fund. What is gift fund? What is a gift fund? All right, here's an example. If you're buying a $250,000 home with a 3.5% down payment FHA loan, which is extremely common, your entire $8,750 down payment could be a gift. Gift money can come from parents, friends, employers, or anyone generous enough to give you a gift toward the purchase of your home. However, if you're going to use gift funds toward your down payment, they have to be properly documented by the gift giver and the home buyer. So they're going to need some proof that those were legit funds. So that means writing a gift letter to show your mortgage lender the money came from a verified source. This extra step in your home buying process will be totally worthwhile. Be sure to let your loan officer or real estate agent know early on in the process that you'll be using gift funds for a down payment. So hopefully this video covered the basics of what a down payment is, and maybe you got a little extra information on what closing costs are. So thanks for watching. Please subscribe for more home buying tips.